Welcome to this weekly installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets this week. My name is Summit Puri and thank you for tuning in. Before we jump into the content this week, I want to wish everyone a Merry Christmas and a Happy New Year. We have 2 short weeks coming up leading into the start of 2025. I hope that you are all full of Christmas cheer while thinking through some of your New Year's resolutions. Now, if one of your goals for 2025 is to get financially free or get your finances in order, our team at Whitaker-Myers Wealth Managers would be happy to assist. Please reach out to our advisors, coaches, or financial planners to walk with you on your journey. Now, let's hop into today's discussion. This week, as usual, we'll discuss 4 key focus points highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at housing starts and building permits data. In point number 3, we'll take a look at the personal consumption expenditures data, or the PCE. And in point number 4, we'll take a look at the Federal Reserve's rate cut decision. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta Fed GDP Now report shows a healthy 3.1% growth as of December 20th. This is slightly down by 0.2% from last week. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data fell by 22,000 claims, ending at 220,000, while continuing claims fell also to 1.874 million. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw a slight uptick in the 30-year and 15-year mortgage rates, ending at 6.72% and 5.92%, respectively. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread fell from 11.67% last week to 9.29% this week. Next, we will continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating an 8.6% probability of a 0.25% decrease and a 91.4% probability of no decrease in January. We'll talk a bit more about this and Fed rate cuts in point number 4. And finally, let's take a look at how the markets ended after this volatile week. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 2.35%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was negative 5.05%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was negative 3.45%. Growth in income stocks were the smallest loser this week, so they take the win. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Now on to point number 2, building permits and housing starts. November saw an increase in building permits and decrease in housing starts. Building permits rose 6.1% to an annual rate of 1.5 million from the revised October reading of 1.42 million. This is beating expectations. Housing starts, however, fell by 1.8% to 1.29 million from a revised 1.31 million a month earlier, falling below forecasts. The rise in permits may reflect growing confidence amongst home builders, while the dip in housing starts could be related to weather disruptions from Hurricane Milton. The housing sector, which performed strongly after the COVID-19 pandemic recovery, faces challenges from high mortgage rates, limited supply, and rising material costs. Builder confidence has been trending upward in recent months, reflecting optimism about potential regulatory relief and increasing demand for single-family homes. However, high interest rates, elevated construction costs, and limited land availability remain significant constraints for home builders. The mixed results, the mixed results in housing starts and building permits illustrates the complex dynamics currently at play within the sector. While the increased permits point to future growth, the decline in starts suggests that ongoing challenges such as high mortgage rates and material costs continue to weigh on immediate construction activity. The future direction of the housing market remains uncertain, particularly as it navigates the impact of factors like mortgage rate fluctuations and the policies of the incoming administration. And now on to point number 3, personal consumption expenditures data. Personal consumption expenditures, which is a key inflation indicator closely watched by the Federal Reserve, rose by 0.1% in November of 2024. This was lower than the expected 0.2% increase and offered some encouraging news for the Fed's fight against inflation. On an annual basis, the PCE index increased by 2.4%, slightly below the anticipated 2.5% gain. Excluding volatile food and energy prices, the core PCE index also rose by 0.1% for the month and 2.8% for the year. This cooling in inflation, even if slight, comes as welcome news to markets still grappling with the Fed's recent rate cut. Wall Street reacted positively to the PCE data, with major stock indices trading higher on the news. The S&P 500, NASDAQ Composite, and the Dow Jones Industrial Average all saw gains, indicating investor optimism about the potential for easing inflationary pressures. The bond markets also reacted with the 10-year and the 2-year treasuries falling, suggesting that investors were anticipating less aggressive monetary policy tightening from the Federal Reserve in response to the cooling inflation. The November PCE report provides more context for understanding the Federal Reserve's recent actions and their impact on the economy. As discussed in our previous conversations, the Fed has implemented 3 interest rate cuts in 2024 to stimulate the economic activity. However, the stock market reacted negatively when the Fed signaled a potential slowing of cuts in 2025. The November PCE report showing a slight cooling of inflation could potentially support the Fed's cautious approach to further rate cuts. Now, while the PCE report painted a slightly brighter picture for inflation, other economic news was less positive. A stopgap spending plan backed by President-elect Donald Trump was rejected by the House of Representatives, raising concerns about a potential government shutdown. Such an event could have disruptive economic consequences, including the delay of publication of economic data. The uncertainty surrounding the spending plan contributed to the market volatility. The uncertainty surrounding the spending plan contributed to the market volatility, with initial recovery efforts losing momentum as the news broke. This highlights a complex economic landscape that the Federal Reserve must navigate as it balances inflation control with supporting the economic growth. Good news, however, the latest spending bill passed by the House, Senate, and was signed by President Biden. On to point number 4, 0.25% rate cut and the impact. The Federal Reserve enacted its 3rd interest rate cut of 2024, bringing the benchmark rate to a range of 4.25% to 4.5%. This move was largely anticipated by economists and aimed to encourage economic growth and ease the unemployment rate. However, the Fed also signaled that they would only be 2 cuts in 2025, causing the stock market to react negatively. The S&P 500 and Dow Jones declined by nearly 3%, while the NASDAQ 100 dipped by nearly 4% after the meeting. Despite the stock market's negative reaction, some analysts believe that the sell-off presents a buying opportunity. The economy remains strong, with indications of expansion and easing of the labor market. And historically, the stock market has performed well in the 12 months following the initial rate cut when those cuts successfully prolong economic expansion. Many analysts see the strong economy as a more significant factor for the stock market than the Fed signaling of fewer rate cuts. While the Fed's rate cuts are intended to lower borrowing costs and stimulate the economy, experts are divided on whether these cuts will significantly impact credit card interest rates. Some credit card issuers have already lowered their APRs or annual percentage rates in response to previous cuts, while others have maintained or even increased their rates, particularly for borrowers with lower credit scores. Factors contributing to slow decline in credit card APRs include the high demand for credit cards, raising delinquencies rates, and the increased cost of deposits for banks. For tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you for watching. We look forward to seeing you next week.